Hello, and welcome to the July Market Update. My name is Brad McMillan, and I'm Commonwealth's Chief Investment Officer. It was a tough month in the financial markets. U.S. markets were down about 2% on the whole. Foreign markets got hit harder, down about 3% on the whole. Even fixed income markets, that is to say the bond markets, lost money for the month by and large. We haven't seen this kind of across-the-board poor performance in some time. And the question really is, what caused this, and what does it mean for the future? What caused it is actually pretty simple. Two words: Greece and China. You've seen Greece in the headlines, and we'll talk about that, but China is actually, in my opinion, potentially a bigger problem, and it hasn't gotten the headlines. Let's start out with Greece. The negotiations between Greece and their creditors collapsed at the end of the month. Why do we care? Well, directly, we actually don't. But indirectly, there was a real fear that this kind of collapse could lead to systemic problems, could lead to breakdowns and explosions throughout the system that we weren't expecting. I would argue that what we saw, we did see a reaction, but it was a very moderate reaction. It was a very thoughtful, rational reaction. In other words, we didn't see panic. We didn't see the blow-ups that we thought we might see. So that, to me, says the risk from Greece is real, but it's not something to panic about. It's much less than we thought perhaps it might be. The other thing that we need to keep an eye on is China. Now, the Chinese stock market just moved into a bear market at the end of the month with great timing about the same time the Greek negotiations collapsed. And again, why do we care directly? Well, we may not. But the thing is, the Chinese government is clearly worried, because they've taken some policy actions that they haven't taken since 2008. Now, again, this is not something to be immediately concerned about, but it is something to keep an eye on. And this, I think, is the rising risk as opposed to Greece, which is probably the falling risk. The great thing about being here in the U.S. and doing this talk in the U.S., though, is that we are actually in pretty good shape. Even though risks remain internationally, here in the U.S., things are going pretty well. We've had 6 months of job creation at 3 million a year. That's something we haven't seen since 2000. That's a 15-year high. We've got consumer confidence at multi-year highs. People are spending money. We saw personal spending spike up at a rate we haven't seen in, again, many years. We've got vehicle sales at a 9-year high. We've got housing sales at multi-year highs. Any way you look at this, the U.S. economic fundamentals are actually very solid, even as the Fed continues to stimulate. Even though there might be more financial turbulence, even though there may well be further issues internationally, the U.S. is as well positioned to ride this out as we have been since before the crisis. So this is where we are. International risks remain. A Greek deal remains quite possible, but it's also quite possible things could break down again. We'll see. China is a rising risk. Other areas of the world, as you know if you read the papers, remain at risk as well. But here in the U.S., we're actually doing very well, and the signs are that's actually going to continue to strengthen. With that, we'll see what happens next month, and I'll talk to you then. Thank you for watching.